Hello, friend. You're welcome to this discussion on techniques for investment appraiser. My name is Dr. Marco Achukwu. We'll be looking at a few things, basically techniques. There are several techniques, but in this discussion, we'll look at four basic ones: net present value, NPV. We'll look at payback period. We'll look at accounting rate of return, and then internal rate of return. All right. Now, why do organizations invest? Organizations invest basically to make profits, and then this profit is made when the organization is able to manage the operation very well. They're able to match their demand with supply, and then they're able to reduce manufacturing costs and other logistic costs. So when a business has done well, it gets profit. All right. So for a business to get into make profit, which is the major goal for business enterprise, it becomes important to check alternatives that are available for investment. You basically you don't just look at one option, and that is why what investment appraiser does, it looks at several alternatives to what that fund can be invested into to see which one that will yield best. Okay, so investment appraiser is basically the way a business tries to assess the alternatives of possible investments. When people say I did it because I have no option, it's basically because they close their eyes to other options. As humans, we always have options, but many a times we close our eyes to the options. So when you have fund for investment and you think critically and you do the necessary thing, which includes appraisal of that proposal, you'll be able to find alternatives to what you are doing. So investment appraiser is basically the process by which one assesses whether to invest or not to invest, whether it worth investing in a business or not to invest in that business. Okay, it is important to estimate the profit that will most likely, come out from that business. Now, a major concept in business investment appraiser is what we call cash flow. Cash flow is just the amount of money that enters your hand. It doesn't mean you are making profits. Okay, as human, we often prefer to make sure that there is turnover. Money is coming into your hands and money is going. It keeps you liquid. So cash flow is the amount of money coming into and going out from an organization, as reported in the earning announcement. It could be money coming in on a particular project or entire business. So there could be a cash flow for a particular line of business or cash flow for the entire business as a whole. Okay, so cash flow is basically calculated by deducting the costs and adding the incomes over a period of time. So the appraisal techniques we will be looking at in this discussion are basically four. Okay, there are so many techniques available, but we'll just look at this in this discussion. Okay, like mentioned earlier, net NPV, payback period, accounting rate of return, and internal rate of return. When using these techniques, you should ignore any sinking costs. Many a times when we look at things on the face value, we quickly ignore that there could be other costs we have not considered, costs that you have already incurred or would incur regardless. You basically ignore them. These are not part of what you are specifically going to consider. What do I mean by that? You already have a factory and you are trying to invest. This factory is already down, so there are other options that are available. So if you begin to check what you're investing and include the cost of that, it could compound issues. So basically you leave out that and look at what that money is going to go in for. So the first one is net present value, to keep it simple. Now, net present value is trying to say that we have 50,000 naira or 50 million to invest, And then this business is going to run for 10 years. Okay, we have 10 years to run. Now, this 10 years, we're able to calculate the cash flow for this 10 years, and we got the amount for each year. That amount for each year, if we do a discounting rate to see the value of that money in the 10th year, in the ninth year, in the 8th year, if we try to find the value in the current year, that's why the name is net present value. We use a discount rate, okay, what we call rate of interest, and then we discount over the number of years that business is expected to run. Okay, leave out these formulas is not something very complicated, but just understand basically what we are doing. If you're able to get the rates of interest per year for the period of the business, and then you ascertain the number of years the business is going to run, you basically use this. That gives you the net present value, of that money that will come over time, and then you're able to compare it with the money you want to invest and see whether it's profitable at all. If you're not careful, you will, in context like Nigeria, when currency is so volatile, you may end up losing your fund. So the other one, net present value, basically tries to, now, net present value basically tries to find out the difference between your current value and the current value of the cash flow that is coming. you know your cash inflow, the current value, and the current value of your cash outflow. So you compare that. So basically, you use it to ascertain if a business is profitable or not. The key thing in net present value is that it has time value for money. It checks, it considers that money at hand today is more value than money that is yet to come. All right, so cash inflow and cash outflow are adjusted based on time value of money. That's basically what we do when we are looking at net present value, NPV. So as a result, NPV determines whether it's worth financially, to invest in a business or not to invest in a business that has future return. So to calculate it, you subtract the current value of the investment you are doing from the current value of the cash that is expected to flow into that business. Okay, so if the NPV is positive, it means that the business is profitable. If the NPV is negative, then is a no area. You don't go there, because from the beginning you already know that you are going to lose in this business. So this is basically the decision rule. When NPV is greater than 0, that's positive, then the project is financially viable. Accept it. If it is equal to 0, then it is only breaking even. If it has more lifespan to run, you may want to consider it. Probably it could become profitable then, but you know that you are just breaking even. Now, if it is less than 0, then the project is not viable. You don't go in there. So if an enterprise has like 2 or more mutual exclusive projects, they are not joined together under consideration, it should be able to choose the one with the highest net present value. All right, so this is how to calculate it, like we discussed earlier. Now, the second one is payback period. Payback period is what we do often. Somebody comes to ask you for money, please give me money, I want to complete my school fees, I want to start up a business. The first thing we normally ask is, when will you be able to return this money? The shorter the period, the less risky it is for you. The business that we pay back over a longer time, it looks more risky, because a lot of unforeseen circumstances could happen. So payback period is simply techniques for assessing an investment by the length of time it would take to repay it. Is usually our default techniques for small enterprise. Somebody is trying to start what to call it, provision store. Somebody is trying to start any business, keke, tricycle business, motorbike business, and it comes to you and say, please, I need so and so amount. The first thing is asked, when will you be able to pay back? So payback period is the length of time between making an investment and the time at which the investment is able to break even. So it refers to that time it takes the business to pay back the initial investment. That's our payback period. So to calculate it, you will take the cost of the investment and divide it by the annual cash. Now you are investing 100,000 and they are telling you it's going to take 10 years to come, that the business will run for 10 years. So you say 100 divided by 10, it gives you the number of time it's going to that business. We'll quickly show you example. So investment with shorter payback period is more desirable than the one that has longer time to pay back. When payback period is useful, is basically when you are seeking to recover back your cash as quickly as possible. Maybe that cash you want to use it for something else, and you want to quickly do a short-term investment. So you quickly ask, when am I getting my money back? It's commonly used for initial screening of investment. Sometimes you don't use that alone for a serious business. You do payback period, and you now use other alternative, techniques to check. So we have mentioned earlier, a longer payback period is considered very risky because it relies so much on cash flow that may have a challenge in future. So the decision rule is also very simple. Only select the project which payback period within the specific time period. Now the investor has a expected time period. He's expecting this money to come in, so you only take the business that falls within that expectation. So choosing between two options, the one with fastest payback period is preferred. Now this is a typical example. I need you to note this is not confusing. This is general approach. Now this is year one. Those of you who are in accounting will understand better, but please, if you are not in accounting, don't be afraid of this mathematics. It's very simple. We understand that a lot of people are involved in this course and some don't have mathematical background, so we try to keep away those calculations. That's why even in net present value we didn't do any calculation. We try to keep this as simple as possible, so that those of you in humanities, those of you in which other area, that are not quite mathematically inclined, you will still get what we are doing. What is our concern is that you get a basic concept here. So when you see this 100 in brackets, in parentheses, it actually means that that money has left your account. This is cash flow. This money left your account in year zero, the year you started business. You invested 100,000. The accumulated cash that came in is still negative. That your 100,000 is still away. Now you did business in year one, 20,000 came in, and then this 20,000 that came in tries to you remove it from the you try to use it to pay back the 100,000 you got, is remaining 80,000. You did business in year two and you got 30,000. You try to still pay back that 100, the balance of 80, you pay 30, it's remaining 50. So your payback period is what we are calculating. Year three, you did business, the cash flow came as 40,000. You still pay back the balance of 50 and is remaining 10,000. So you're almost getting to your payback period. Now the fourth year, you did business. If it is just 10,000 that came and you clear that, this cumulative cash flow would have been zero here, and that would have been exactly 4 years that you're able to complete the payback period. Okay, now but look at what happened. You got 30,000 and you pay back the remaining 10,000 and had a plus of 20. So invariably, in the third year plus some months, you were able to pay this money. How do we know that month? So your payback period is 3 years basically. This three, because that was it was after this three we had extra. So 3 years is your payback period, and then the balance remaining that you paid is 10,000, and what you got in the 40 is 40,000. So 10,000 divided by 40 is trying to give us that fractional month that it took to complete the business, the servicing of the fund. So that gave us 0.33. 0.33. So we got it at 3 years, 3.33 years. 3.33 years. What does it mean in months? Now, if you go to Excel, and don't mind me, I just put plus here, and say that's 0.33, 0.33. That is the fraction there. Divide by 1. 1, because if it has gotten up to 1, it would have become 4. That gives us a value. Okay, now, but that value, if you multiply it by 12, that it takes to be 1 year, 12 months makes 1 year, 12 months make 1 year, and you calculate it, it gives us 3.96, approximately 4 months. So that is how we got 3 years and 4 months as the payback period here. So the answer is basically 3.33 years or 3 years 4 months. I hope that doesn't bring in any confusion. Okay, now the third one is accounting rate of return. Accounting rate of return compares the profits expected to make from an investment to the amount you need to invest. Okay, so the amount you need to invest, if it's 50,000 and the bank has an interest rate of 5%, if I'm investing this money, what the bank will pay me 5% interest rates, will it be better for me than investing that money? That is basically what you try to do here. So ARR, accounting rate of return, is a ratio used in capital budgeting to calculate an investment expected return compared to the initial costs. Okay, unlike NPV, accounting rate of return does not take into account the time value of money. Now, if your ARR is greater or equal to the required rate of return is that amount I said. If the bank is willing to pay me 20% for my investment, and then I invest this business, the rate is going to return to me, will it be up to 20%? If it is not, then it's better for me to invest it in the bank than going to suffer in that business, yet not getting as much as the expected rate of return. So if the ARR is equal to or greater than the rate of return, then the project is considered profitable. But if it is not, equal to or greater than, then it doesn't worth investing in. For instance, if my accounting rate of return for a particular business is 30%, it means that that project, for every 100 naira invest, that we're expecting 30 naira. That's 30%. Okay, so the method does not take into account all the years that are involved. You lump everything together and do this. So if the various accounting rate of return are considered, now all the proposal, or if for instance I have 50 million to invest, and my investment analyst, what he is supposed to do is to do all this analysis and advise me that if I invest in business A, I'm going to get a return of 10%. If I invest in business B, I'm going to get return of 20%. If I invest in business C, I'm going to get a return of 18%. Now, the preferred order for these businesses would be the one with the highest rate of return, which is B, followed by C, and then followed by A. Now, if the prevailing rates of interest in the bank is 15%. The bank is willing to pay me 15% for that business. It is called that automatically the option of A will not be considered in this business at all. Instead of investing in A, proposal A, to get 10% return, I'd rather put it in bank and get this 15. But I will consider for 20%, and I can also consider for 18%. You think it's small? When this thing runs into million, you know it's a serious business here. All right. So now these are different formulas for calculating this. It shouldn't give you a headache. Just get to understand the concepts. That's our interest. Sometimes you calculate ARR on annual basis, and if you are doing it on annual basis, you look at profit for the year, divide by assets book value at the start of the business, then times 100 because it's in percent. The same thing with total investment basis. You look at average annual profits and initial capital invested, you know, and then calculate it. The same thing with this other one. So these are basically how to calculate it. The last one of interest here is internal rate of return. Internal rate of return defines, you know, is defined as the discount rate at which your NPV is equal to 0. Now the NPV we calculated before, okay, you are checking all the money that this business is going to bring over time. At what point does it break even? At what point does it become 0? You remember that if it is 0, you could say 50-50, you may or you may not invest. If it is greater than 0, you quickly invest. If it's less than 0, that NPV, you will not invest. But that accounting rate of return brings it to 0 points. In other words, IRR represents the break-even discount for an investment. So it's trying to find at what point will this investment break even, so that we'll know whether to invest or not to invest. If it breaks even so early enough, then we may want to invest, because other years will begin to reap our dividends of business, of investment. So put differently, IRR is percentage discount used in capital investment appraisal, which brings the cost of a project and its future cash inflow into equality. You know, so we'll quickly show you how to measure it. So these are all about the definition. The rate of computing AI depends on the bank rate. So you quickly check the bank rate of that investment and know whether it's going to be more than that. So the test for the test of probability of a project is the relationship between the ARR. If you want to check whether a business is profitable or not, you check the ARR, the IRR, internal rate of return of that business, you know, and the minimum acceptable rate, maybe what the bank could offer you. The decision rule is simple. If internal rate of return, you know, can be stated in the form of ratio as it is shown below. Now, internal rate of return, it can be stated as is shown below, where cash inflow divided by cash outflow. Cash inflow is that money you are investing, divided by cash outflow, it gives you 1. Okay, so the present value of that cash minus the present value of the cash outflow gives you 0. That's rates that makes, you know, you have present value of your cash inflow, this money you have invested, and there is a discount rate we are using to check this cash outflow. That's the money you have invested. Okay, there's a discount rate we're using to check the cash inflow over the years to be able to know the present value of that cash flow. So if that rate that returns this thing to 0 is our internal rate of this thing, our internal rate of return. Now let me show you that thing again. You know, we had seen this before. Look at this rates here. You see this rate here, interest rates. The rates that gives you that present value that makes it equal brings the money that is coming in over years equal to the money you have invested, making you to break even. That's the internal rate of return. Okay, now the decision rule is simple. If the internal rate of return is greater than the cost of capital, the cost of capital is like the money the bank is going to give you. If you're going to borrow that money from the bank is going to cost you, charge you interest. So if it is greater than what bank will ordinarily pay for that money, that's the cost of capital, then you accept the project. But if it is less than what the cost of capital, then you reject the option. This is a bit complicated. Don't get yourself so worried. But this is basically a formula for calculating internal rate of return. Okay, we're not going to spend a lot of time there. It's important to note that present value, net present value, NPV, and the internal rate of return are two types of discounted cash flow. They use discounted because they consider time value of money. But payback period and accounting rate of return are two types of non-discounted cash flow because they don't even consider what happens with money over time. Okay, good. So the last very thing I want to quickly do is just different stages of capital investment. Is not a very big deal. The stages are simple. One, you first identify the investment opportunities. Okay, you may need to do a lot of research, and considering the objective of the business, you identify the possible business opportunities. Always look for options, don't close your eyes. That's why sometimes people need to think outside the box to get options. Okay, now you quickly screen this investment proposal. You screen them maybe on a quick way of screening to see the possibility, the ones that may be considered and the ones that may not be considered. Okay, so that you select those proposals that are best strategically fit for given the economic resources available. You may see a very beautiful project but you don't have the fund, so you may keep it aside. Now you quickly analyze, you evaluate this investment. So the first one, you identify, you screen, you analyze, you evaluate, then you approve the investment. If the investment passes the appraisal level, you approve it, and then you implement the business, you monitor the business, and then post completion audit, you quickly check whether you are in order or not. All right, so thank you very much for paying attention. Thank you for joining this class. I wish you the very best. Cheers.